Hey everyone, welcome in to another daily editorial here on the KE Report. I'm chatting with Jeff Christian. We're going to be talking some inflows into the gold ETF GLD and also recapping some of the majors. So look, the majors are making some good money from their production at these higher, especially precious metals and gold prices. I have some questions for Jeff about how they're going to manage that money, even potentially hold some of the precious metals that they produce. I'm looking forward to getting Jeff's insights on that. Jeff is the managing partner at the CPM Group. I will post a link to the CPM Group's website in the show notes. Jeff, just a quick recap here in terms of money flows. For the first time, at least out of North America, significant inflows into the gold ETF GLD were reported in July. As we started out this year, January, February, major outflows from North America. And then we got to March, little inflows there, pretty much flat through April and May, some outflows in June, and then July, this major spike in terms of the Western investor taking part in this gold rally. In July, we even saw gold up about 5%. So, Jeff, what's your takeaway from it seems like this shift? It was a gradual shift. It took 4 months for the North American investor to really take part in GLD in that gold rally. Do you think this is sustainable for the North American investor?
Well, I think it's sustainable, but I don't think it'll be sustained. Yeah. So there are two trends that are going on with gold ETFs, and one is a longer-term trend that's been going on for 3.5 years, which is investors disgorging ETF holdings. And the other one is the shorter-term increase that we've seen, as you said, really starting in March, but almost half of it was in July alone. And I think if you look at the longer-term trend, the fact that investment holdings in gold ETFs have been declining for 3.5 years, what you see there is not so much investors saying, I'm not interested in gold. There's been a concern about counterparty risk. Yeah, and some of the investors who have been selling ETF holdings over the last 3.5 years have replaced them with physical gold owned directly in depositories, usually non-bank depositories. And what you've been seeing in the disgorgement of ETF holdings is counterparty risk concerns. So that's been going on. Now, since March, you look at the gold price. The gold price, it was in this range of 2,000 to 2,100 in January and February. It broke out of that in the beginning of March and started to rise and rose further in April, and it's been at record levels. And what you're seeing with the additions, I think, is any number of investors, institutional and individual, retail, and large people. There are investors who said, gold prices are rising sharply. I want to buy gold price exposure. And the easiest and fastest and cheapest and most efficient way is to buy ETFs. So as the gold price was rising, I think you had any number of people who were not investors in gold saying, I need gold price exposure, let me buy ETFs. And you saw that in March, and then, as you said, kind of like petered out a little bit, and then it picked up again in July. And the gold price started July someplace around $2,340, $50 an ounce, and it's $200 higher than that today. So that partly reflects that inflow. But yeah, you had about 932,000 ounces of gold additions to ETFs over the course of July. And it looks like a reversal of this 3.5-year trend, but our view is that it probably reflects just a shorter term impulse to buy gold price exposure as fast and easily as you can, which is through ETFs. And I think that if the gold price peaks out at some point, you'll see that come off. Or if you see counterparty risks pick up, which probably isn't going to happen, although you really don't know because we're shifting the interest rate environment, and that could have negative implications for financial institutions if they're not well prepared for a shift from 5.5% interest rates to something lower. I think that at some point you'll see those investors get out of those ETF positions because I think the counterparty risk is still there and it's still very high in a lot of investors' minds.
But Jeff, doesn't this show a bit more of the larger investors starting to take part, at least in North America, in this gold rally, which was, in a way, missing component of a lot of this move in gold over the last few years?
Yes, it does. And it shows that the gold investment market is composed of many components. And I think there's this like quasi-racist thing. You know, many years ago, some mining executives at one of the largest mining companies in the world was on a road show in Europe, and they called me up one night, their time, and said, Jeff, what's the difference between investment demand and hoarding demand? Because people here in London keep saying, well, investment demand's up, hoarding's down, or whatever. And I said, investment demand is, in their mind, what white people do in Europe and North America, and hoarding is what the rest of the world does. It's really the same thing. And there's this racist type thing, oh yeah, well, Asians and Muslims, they really love gold. And they do. But I think there's been this view that most of the demand over the last couple of years that's driven the gold price higher has been in Asia. And it's true that Asian demand has been very strong, especially in 2023 and the first half of 2024. But there has been strong demand in North America and in Europe. It just hasn't gotten the press that the Asian markets have. And I don't know why. It may be that there's a predisposition on the part of metals market reporters to focus on Asia, or it may be that there's greater discretion in the U.S. and North American and European markets on the part of institutional investors as disclosing what they do. But whatever it is, that demand has been there. And one of the components is longer-term investors, but another component is a very opportunistic group of institutions and individual investors who don't want physical gold necessarily. They want gold price exposure. And ETFs, futures, and options are a great way to buy exposure to rising gold prices without buying physical gold. And you can do it on a leveraged basis this way.
Yeah, that's a key distinction, though, and those are more, I think, the generalist investors that aren't all in on gold or on anything at any time, but ETFs, an easy way to get exposure. This is something that we're going to follow along with, see what these inflows or outflows look like as we progress through the rest of the year. Let's switch our focus now to the major miners. I have a question for you because, quite simply, these majors are making some good money right now. Their earnings reports have been relatively strong. Even if they're running into some operational issues, they are making money from their mines. Yes, they need to keep reinvesting back in their mines, but everyone's saying, what are they going to do with this money? A lot of the people in the junior, mid-tier sector are saying, let's see some M&A. Let's get some excitement going there. Why, though, Jeff, do these majors who have investors that clearly like gold or the underlying metal that they're making or mining, why do they immediately seem to turn around and sell this metal for dollars rather than hold it on their balance sheet?
It's a good question that I don't quite know the answer to. I've been an advocate for this for years. And in fact, many years ago when IAM Gold first started pouring and selling gold, they were our client. And they called us and they said, we need your assistance on hedging the Canadian dollar exposure because, we're mining gold and we're selling it, we're getting US dollars, and then we convert them to Canadian dollars and put them in our treasury, and the Canadian dollar at the time keeps falling. So we need a Canadian dollar hedge. And a Canadian dollar hedge is kind of complicated the way we do it, and the board was really having trouble with it. So we said, why don't you stop selling all your gold? Sell the gold for US dollars that you need to sell to have the cash to operate your company with a little extra, but then take your extra profits and leave it in gold and say to your investors and to the broader investment community, you buying my share because you want exposure to gold prices. We're a gold mining company. We're in production now, profitably in production, and we're holding part of our treasury in gold. So we get this like double whammy gold exposure with our shares. So IM Gold did that, and then Gold Corp did it, and then we did it later, several years later, with Silver Standard, when they had cash from a disposal of an asset, but they didn't need the cash immediately because they weren't going into production or construction of the Perquitas mine. So they had a period of time when they had cash that they, were just holding against when they needed it to build Perquitas. And we said, buy silver. And that was at a time when the price of silver was like $4.50 an ounce. So I've been an advocate for that kind of using gold and silver as a treasury asset for decades, a couple decades, that we're talking about here. I don't understand why companies do that other than the fact that they're comfortable, their treasury operation is comfortable having their assets in currencies. They do need currencies. A lot of these guys are constantly running through cash flow. So there's a need to do that. And also the industry is set up. The way mining companies operate is typically they sell their gold when it's in concentrate or doré form to a smelter or a refinery, or they deliver it to a smelter or a refinery and they sell it to a bullion trading company or a bullion bank, and they get 80% or 90% of the value when they deliver that material in concentrate or doré form, and then they get a final settlement on the outturn at the refinery. And when the final outturn comes, whoever they've been dealing with, whether it's the refinery or it's a bullion dealer, will say, okay, we have X dollars and X ounces of gold on outturn. Do you want to sell it to us? Do you want to sell it to somebody else? Or do you want it? And if you want it, do you want it in our vault for now? Or do you want us to ship it to somebody else? And usually they just say, let's sell it at that time, because that's sort of the way the industry works. Doesn't mean that you don't have to do that. You can easily say, I want to keep it. And frankly, I think some companies do keep some of the gold and they bury it someplace in their balance sheet. They don't seem to want to tell people that they actually own a few thousand ounces of gold in some cases. So they kind of bury it in their balance sheet rather than use it as a promotional tool to say, hey, not only are we producing gold profitably, we hope, but also we are holding some of our treasury reserves in gold to give you additional exposure to rising gold prices. I don't know why they don't do that. I do not have an answer.
Yeah, to me, it really seems like a missed opportunity, especially to connect even more with their shareholders. But on the back of this then, Jeff, if a couple of these majors started to withhold at least a little bit of gold that they produce, hold it on their balance sheet, could it at all impact the pricing model around gold as well, because there just wouldn't be as much supply hitting the market every year?
I think it would have a de minimis impact on the price of gold. It probably would have more of a psychological impact than an actual physical impact. Obviously, if you're taking out, let's say that 5 companies took out 100,000 ounces each, you're taking out 500,000 ounces of gold in a 100 million ounce gold market. Yeah, you could have some impact on the market, but there's so much gold above inventory, above ground. There's so much gold coming in from other companies and from scrap refining and electronic scrap refining, jewelry and decorative object refining. It probably would have a very small effect in terms of tightening the physical market enough to push the price up. But it would have a greater psychological effect because people in the gold market would say, ooh, there's a new group of gold investors, and those are the gold miners. And yes, they're gold miners, but if you're holding gold bullion as an asset, you are a de facto investor. And I think that if gold mining companies did that, it would have a greater psychological effect on the market where people say, whoa, okay, these guys are good. And they maybe are running their companies, their gold mining companies, in a way that signifies greater consciousness of the value of being a gold miner.
Yeah, to me, it just seems like a big lost opportunity. And not to make comparisons to cryptocurrencies, but those miners, they hold cryptocurrencies on their balance sheet. It actually provides extra exposure to the underlying product that a lot of the investors want a piece of. To me, it just seems like a missed opportunity. And to your point about what these majors do when they produce gold or whatever metal it is, usually they then send it off to a refiner. There's a number of different stages to get to, let's say, a coin or even a full doré bar. Why don't some of these majors vertically integrate more rather than simply being at the bottom of the food chain, spending all this money to produce these metals, especially gold, and then immediately sell it so that someone else can make a margin off of that raw material?
I think there's several reasons. One is a matter of expertise. I'm a gold miner. We know how to mine gold. We're not refiners or smelters. Refining and smelting is a radically different business. It's a different level, a different school of expertise to begin with. It's also a capital-intense industry. So you need the capital to build smelters, and then you have pollution issues with smelters. And you need the capital to build the smelter and or refinery. And then you need capital to hold in working inventories, given the nature of refining. So there's a lot of capital intensity, but I think it's mostly that mining companies say, we're mining companies, we're experts. If we were to build a new refinery, we'd want it to be a good delivery refinery. You have to have several years of track record to apply for good delivery status in London or New York. So we're going to be tying up capital for a number of years before we really have the ability to sell good delivery gold that we're producing. I think there are a lot of issues there that the mining executives say, we're miners. Let's continue to focus on what we know how to do best, which is mining, as opposed to smelting or refining. I think that's what you're looking at.
Jeff, is this attitude from the majors then of this is what we do, this is what we know, is it holding the sector back from bringing in more investors, from bringing in some excitement? Because quite frankly, these majors aren't trying anything new.
Yeah, it probably is. And I do think that there are any number of generalist investors who look at the mining industry in general and maybe precious metals in particular and feel that it's kind of a stodgy, mature industry that doesn't necessarily want to branch out. That said, there have been companies that have tried to branch out, maybe not in smelting and refining, some of them have, but into specialty metals or other things, and it hasn't necessarily gone well for a lot of those companies or their shareholders. So I think there's a reluctance to try something new, and there's a management frame of mind. We see this with hedging. If I do nothing and the price of gold falls and my company goes bankrupt, that was the market's fault. If I try to do something to enhance the value of my company and it doesn't work out, that's my fault and my job. So I think there's a great deal of executive caution on the part of trying new things. And that's probably true across industries, but it's definitely true in precious metal mining.
Yeah, it's unfortunate. I think it really is holding the sector back. But hey, in all fairness, everyone got mad at these major companies for too much M&A last bull market major run. But now everyone's wondering, since they have this cash, are they going to do some more M&A, some more acquisitions? Do they need to replace these ounces in the ground that they are mining? Or do they have organic growth? Maybe in some of these projects that they bought at the end of the last bull market that now with metals prices so much higher, even though costs have gone up, do these projects become part of their longer term growth initiatives? Can you speak to that? What majors are looking at balancing out M&A versus organic growth to replace the ounces that they're mining?
From what I can tell, and I'm not a mining analyst, although we do obviously study the mining companies and we work with several of them as our clients. From what I can tell, the mining industry, the majors, continue to think that most of their reserve growth will come through M&A and acquiring deposits and maybe pre-production mines. I think they focus more on acquiring than organic growth. And also, the other component is brownfield exploration. So I've got a mine, and the best place to look for new deposits or new reserves to mine are adjacent to my existing mine, where I have a good understanding of the reserves and resources and the deposit structure. So I think it's that within the ring fence exploration and M&A that they look at for most of their reserve growth, with a view that distant greenfield exploration possibly has more risks than those two things have for the mining company's balance sheet.
Do you think these majors want mines that are already built, albeit they might be a little bit smaller because it takes some of that build risk off? Or are they just looking simply for those large assets that maybe still have some exploration upside and build it themselves because these guys are mine builders, the majors?
Yeah, I think it's the latter, that they really are looking for things. One of the issues is the reverse M&A, where the larger mining companies have very good deposits, but they're small. And it's like, why are we spending all of this money working on these smaller deposits? We should be concentrating on ever larger deposits. So I think that when it comes to acquisitions, what they tend to do is look at larger deposits and larger projects that other people have discovered that need the capital and development expertise that the majors have.
So, Jeff, final question then. Since we're talking majors, how they're managing their cash, what is your assessment broadly of the debt levels still within these majors? They have come down, but should that be a priority even further for these majors to lower some of their debt with some of these higher interest rates we're seeing? And quite frankly, cost of capital is still fairly expensive.
Yeah, I'm basically a debt-averse person. And that said, I do realize that you need debt to grow, but I like to see structured debt. And the problem is, I think that a lot of the times the mining companies' treasuries will rely on the providers of the debt to structure these deals, and they don't necessarily get the best deal. So if you're looking at like a prepaid forward or some sort of long-term offtake agreement, they don't necessarily succeed in optimizing the deal, and they leave a lot of gravy on the table for the providers of that debt that they don't necessarily need to leave on the table. So.
All right, Jeff. Hey, very interesting conversation here. It's something that I've been talking a lot with actually Silvercrest Metals about, where they are holding precious metals on their balance sheet, and they've seen an increase in investor sentiment towards that stock. They're one of the, I guess, kind of mid-tier companies that is making money through mining, and they're trying to push this initiative. And I would like to see more of it. Simply some of these majors taking the initiative, trying to take a little bit of control of the market and at least show investors that, hey, they care about the product that they are producing as well. Jeff Christian, managing partner at the CPM Group. Always a pleasure to chat with you, Jeff. We'll chat again next month. I hope you have a great rest of your month.
Yeah, thank you. And I look forward to talking to you next month.